Hi, I'm Leah and this is Zane, and the name of the paper that we're going to review today is the Time-Aware Graph Relational Attention Network for Stock Recommendations. We're going to go over this presentation the same way that the paper is broken out. So we're going to go into the introduction, then we'll cover some of the preliminaries, we'll go over the methodology, the data sets, the experiments, and we'll end with the conclusions. So the introduction, the stock market plays a really important role in the economic operations of a society. Generally, a higher stock market valuation implies higher economic performance of a company in a country. One primary problem within the stock market is how do you predict the future prices of a company? And so a lot of machine learning and traditional statistical models are used in order to try and quantify the strength of a company. Part of that, companies can be classified into a sector industry, which categorizes various companies into one unit. However, these sectors, companies can vary, correlations companies can vary in strength. One example is Kohl's and Target are going to be in the same category. However, they may not be as strongly correlated as something like Target and Walmart, where they're going to sell more similar products. So this paper is going to examine how do we quantify the strength of those connections amongst corporations that in a way that takes into account the time-aware correlations. Before we get into the meat, there's a couple of preliminary definitions that need to be understood, and that was covered in the preliminary sections of this paper. The first is the stock retention graph. And that generates a feature vector for each time step that represents the stocks and its relationships to the other stocks. So each stock, each node is a stock, and then there's the edges represent, the weight of the edges represent the strength of the relationship between those stocks. There's also the stock recommendations that will define the ground truth ranking score as the return ratio of the stock at closing on day T. Moving into the methodology section, we see the overall model. This model is broken into three sections. First is the feature extraction section. Next is the time-aware graph relational attention network, or TRAN section. And then finally is the ranking prediction. This first section, the feature extraction, takes the description documents and the historical sequences. And the historical sequences are encoded using a long short-term or LSTM network that is applied to that sequential data in order to encode these features over a given time. Additionally, the description documents are encoded using numerical topic numbers. This then is fed into that TRAN section of the model. And this section is made up of two primary components, the time-aware relation network, and then that's the graph convolution network. So the TRA uses an activation function that's stronger when there's a time-aware relationship that exists. And in the interaction, it calculates the importance of the stocks and that relationship using the various stock features and the time-aware relationships historically, and then also the descriptive documents as well. This is all fed into that stock relation graph that we talked about in the preliminaries, and so it encodes the time-aware relationship between the stocks as well as their strengths. This is all fed into the graph convolution unit where the features are aggregated to the given stock, and it represents that day of time. So this unit doesn't capture the time-aware relationship itself, but that's because that's fed in from the previous section. So once the output of that graph convolution unit goes into the ranking prediction method, and that uses a leaky ReLU function in order to get rankings, and then also a pointwise regression and a pairwise ranking aware loss function.
So in order to train this model, the team used a data set that consisted of three main parts. The first is stock historical data. So the team used stocks from both NASDAQ and the New York Stock Exchange with historical sequences from the beginning of 2013 to the end of 2017. The second part was stock description documents, which were taken from Yahoo Finance. And these are what was used to classify the stocks in terms of their industry classification. These industry classifications were then used to construct the stock relation graph. And the team came up with 112 different sector industry classifications for NASDAQ and 130 different classifications for the New York Stock Exchange stocks. So here, just a visual example of the data. You can see that their data sets are in three parts, and the NASDAQ and New York Stock Exchange data is kept separately and was evaluated separately as well. So in order to evaluate the model, the team needed to adopt a market simulation strategy, which had a few assumptions. The first of which is that the investor spends the same amount of money on trading every day. The second is that the stock market was liquid enough to satisfy any trade that the investor wanted to make. And the third was the investor was going to buy the top stock at closing price that the model predicted and sell that stock the next day. The model was evaluated with three different evaluation metrics, the first of which was mean squared error, which evaluates the difference between the predicted one-day ratio gain and the actual one-day ratio gain score for each stocks every single day. The second was mean reciprocal rank, which is an evaluation of how accurate our predicted ranking of highest to lowest gaining stock was compared to how they actually turned out. And the third, which was the main metric the team was trying to maximize, was investment return ratio, which is the sum of the return ratio on each testing day based on the simulation strategy. So the goal for this model was to have a low mean squared error, a high mean reciprocal rank, and a high investment return ratio. So in order to know if your model is any good, you need to be able to compare it with other models. And so the TRAN method was compared with the following prediction methods. Rank LSTM, which treats stock prediction as a return ratio ranking task based on LSTM, which was covered previously. GCN, which is very similar to TRAN, but replace the TRAN network with a common graph convolutional network. And then RSRE, stock prediction model, which is based on stock relations and uses explicit modeling. And then RSRI, which is the same as RSRE, except for with implicit modeling. So in the experiment's results, it was discovered that in investment return ratio and mean squared error, TRAN outperformed all other models in both the NASDAQ and the New York Stock Exchange. Why was the stock relation graph important? The TRAN uses relations while rank LSTM does not, and performs better than LSTM in every single metric except for the NASDAQ MRR. And so one possible explanation of this is the fact that since TRAN uses relations and LSTM does not, and it's more difficult to calculate relation strength on a more volatile market, and NASDAQ is considered a more volatile market, is a possible explanation for why TRAN did not perform very well in MRR in the NASDAQ. Why was the time-aware graph relational attention network important? Well, when compared to GCN, which looks at stock relations but not temporally, and RSRI and RSRE, which do look at time-aware relations, RSRI and RSRE perform better than GCN. And TRAN outperforms all three of those models on all metrics in both NASDAQ and the New York Stock Exchange. So in conclusion, TRAN utilizes both series and textual information to characterize stock relation. The time-aware attention mechanism captures the strength of relationships between stocks and can also adjust the strength over time, since the strength of relationship is not always a constant static thing. The graph convolution is used to aggregate stock features with the relation strength, and the model ranks stocks according to the expected return ratio from one day to the next. The experimental results show that TRAN achieves better performance than other stock recommendation models and shows that TRAN is a great advancement in the future of stock prediction.